Hello, everyone. Welcome to a Wall Street from Main Street podcast. My name is Mo Dawoud, and today's special guest is Chris Whalen. He is a senior managing director of Tangent Capital Partner in New York City. Chris is co-founder and vice chairman of the board of directors of Lord Whalen, parent of Institutional Risk Analytics, the provider of bank and company rating, custom analytic, and consulting services. Chris is also the author of a 2000 book, Inflated: How Money and Debt Built the American Dream, and he also contributes to Zero Hedge and the American Banker. Chris, thank you for coming on for Wall Street from Main Street podcast today.
My pleasure.
Well, Chris, today I wanted to talk about the banking industry, which is, for some people, like rocket science, because there's a lot of stuff going on in the banking world, and a lot of people don't understand it because they throw a lot of financial jargon to throw people off, and people just kind of wonder what's going on there today. But if you want to summarize what's going on, the banks out there are pretty much insolvent and over-leveraged. So I want to ask you, what is the current status of the financial industry as of today when you look at their balance sheets and financial statements?
Well, it really depends where you look. In the U.S., in a nominal sense anyway, the banks are in relatively good shape. If you look at the quarterly data that you can get on the FDIC website and their overview of that, what you see is that the banks' loss rates have fallen dramatically, and they are really delevering in a sense because many banks are not making enough new loans to keep up with the redemption of the old loans. So when a loan gets paid off, obviously the bank has that capital again, and they are not finding customers to lend that money to, so they're shrinking. And, this is bad, obviously, because in our economy anyway, you get job growth when credit is growing, private sector credit. And if private sector credit is shrinking, then obviously you're not going to get good results in terms of the economy or job growth. The other important part of this equation, if you think of, sources of credit for the economy, is that the gray market non-bank sector, where a lot of the shenanigans occurred during the mortgage boom, is also running off. In other words, as bonds are either redeemed or they take a loss, that credit's not being replaced. So on net, you're seeing a lot of withdrawal of credit for the economy. And this hurts banks, obviously, because if they can't make loans, they're not going to make a lot of money. The big guys, U.S. Bank, Wells Fargo, have recently been doing a lot of volume, but mostly for government-guaranteed loans, HARP loans, which are loans for homeowners that are underwater, that sort of thing. So banks are very much dependent on government right now as far as the production of assets for them to put on their books. And they're not taking a lot of independent credit where they would face a loss. Same thing with investors. Investors are really not looking to take a lot of risk at the moment, even though everybody's starved for income. So I would tell you that the U.S. system looks okay in terms of capital. They don't really need more capital, in my opinion. We have a comment on the Institutional Risk Analytics website today that your listeners might find interesting in this regard. But, the problem is that it's all politics. And politicians love to talk about bank capital because it makes them sound tough, right? But at the same time, they follow policies on the fiscal side or housing or whatever it is that are reckless. So the net result is bad, but they still talk about bank capital in an almost religious sense. So, you got to kind of peer through the appearances and parse just what it is that's actually going on here. And I think we're stepping on the brakes too hard. I think the regulation, Dodd-Frank, all the things that you've seen the last couple of years are going to have a very negative effect on the economy next year.
And that's a great point. And one of the entity in the government that's helping keeping the bank propped up is the Federal Reserve. And we have a lot of CEOs and chairmen that sit in the Federal Reserve meetings. So, they have a lot of influence on the monetary policy and what they can do for the big banks. And you saw that in 2008 when they rolled out the bailout for the big banks. So I want to ask you, there's a lot of unfair competition in the banking industry when you compare the big bank to the smaller bank and credit union. How does the relationship to the large bank affect the smaller bank and credit union in the financial industry?
Oh, well, you're right. I mean, in housing, for example, what we were just talking about, you have a cartel. And the cartel is basically the top 5 banks J.P. Morgan, Citigroup, Bank America, Wells Fargo, and U.S. Bank Corp, which is the smallest of the five. And they basically have a monopoly on dealing with Fannie Mae and Freddie Mac. So if you're a little community bank and you want to sell a conforming loan to Fannie or Freddie, you're not going to do it directly because you don't have the people and the infrastructure set up to deal with them. And they have very stiff rules now. So the big banks end up as the aggregators of all these loans that are made by little banks, and they'll put thousands of loans together, and then they'll go out, get a guarantee from a federal agency, and then sell a mortgage-backed security, a Fannie or a Freddie deal, as you would generically know it on the street, right? So the little bank has to give up more than half of their profit on the loan when they sell the loan to the big guys. And even though it lets them go out and make another loan, it does take a lot of economics away from them. At the same time, they also lose a relationship because they're selling the loan to Wells Fargo, for example, servicing released, which means Wells Fargo gets the relationship with the customer, and this hurts the little bank. So our whole system, unfortunately, is very much one of cartels because, unfortunately, my favorite president, Teddy Roosevelt, was willing to use the government to break up concentrations of economic power. But in this case, we're actually letting government policy create cartels. And it's almost deliberate because, the people at the Fed and other federal agencies, they like big institutions. They see small banks and smaller entities as troublesome. So, there's an institutional bias against smaller banks, and it's reflected very much in policy. So, for example, you had the emergency insurance at banks from the FDIC for transaction balances after the crisis. And I think it's going to expire at the end of this year. And it was supposed to help little banks because they figured, well, if we don't cover these balances, customers will be afraid to keep, say, their payroll account with a bank, which would sit in a non-interest-bearing account. But no, really, it was helping Wells Fargo and U.S. Bank because they took that funding and they went out and they were very aggressive in the mortgage market this year. And you can see that in the FDIC statistics. They picked up a lot more funding because of that emergency guarantee than the little banks did. So hopefully that's going to go away at the end of the year. But we have a lot of work to do to try and rebalance the competitive equation for smaller institutions.
Yeah, I agree. And what we see now is it's sort of like a monopoly on the mortgage industry and the banking industry, where we have a group of large banks that controls most of the financial asset and capital in this country, and there's not much competition going on, especially in the mortgage industry, where customers who want to buy a house can go to all the different banks to try to get a mortgage loan. They're pretty much stuck with these few banks that control all the mortgages.
Well, quite right, but you got to blame Elizabeth Warren and all the liberals for this, because they come in and say, oh, we got to regulate the market, and that's fine. We definitely need to attack fraud. But the regulations they put in place, say with the Dodd-Frank law, has gutted third-party mortgage origination. All those little private companies you were just talking about, they're gone. They've been just driven out of business, and part of it's licensing and other state law requirements that have been imposed. Part of it's the settlement, the robo-signing settlement that was supposed to protect consumers. But the net effect of the settlement is it's going to dramatically decrease the availability of credit for people who want to buy a house. So you got to weigh these things very carefully, and I think we've gone overboard with some of this stuff. Some of it was common sense, right? If you read the settlement, most of the normative standards that they imposed on banks, that's fine. But did we really need to use the Dodd-Frank law to put all of the non-bank originators out of work? And the big banks, the ones we were just talking about, the cartel, they're not even buying third-party production from little banks anymore. So you're going to have a dramatic decrease in the amount of credit that's available, because if I'm a little bank, you remember the Jimmy Stewart movie? If I can't sell that loan to somebody and get my capital back and do it again, then my volumes are going to decrease, right? I'm going to make fewer loans. So the whole system is kind of in gridlock now because of all the regulations we put in place. And, much of this is inspired by Ms. Warren, who I described lovingly as an angry Calvinist. So...
Oh, yeah, I did see that on your Twitter feed the other day. Yes, you angry Calvinist. Now, I wanted to ask you, the financial industry is probably one of the most regulated industry in America. If you second to probably the aviation industry. Now, a decade ago, President Clinton repealed the Glass-Steagall Act. Do you believe that the repeal of the Glass-Steagall Act contributed to the financial crisis that happened in 2008, or that if we still had it in place, the 2008 financial crisis would have never happened? Do you believe that?
Well, I think you could make that case in part, but I think the more important thing that happened at the same time was that we saw a lot of markets going from public exchanges and very transparent marketplaces to these OTC private markets. And particularly subprime debt, they were all done as private placements. So we don't have any public disclosure for these securities. A lot of the contracts that were used to create synthetic debt obligations that had terrible losses, again, are over the counter. We have no disclosure on these instruments. So I think that you had a whole period of not only taking regulatory rules off that had been put on during the 30s, but also allowing a degree of securities fraud that we haven't seen since the 20s and the 30s. And unfortunately, we still have been unwilling to attack this. And a lot of people say, well, you can't throw people in jail, you're going to destabilize the financial system. But I disagree. If you don't throw people in jail and hold people accountable for creating fraudulent securities, then you're never going to restore investor confidence. That's the problem. Because they look at this and say, wait a minute, I lost 30% on this bond issue I bought from Bear Stearns, for example. Why should I buy more? And this is how you finance housing, for example. So, the dysfunction here is not just because we allowed securities firms and banks to be owned by the same company. That's part of it. But frankly, I think what we need to do is just the opposite of re-regulation. I think we need to take away the restrictions on ownership of banks. And we could regulate the narrow bank that's insured by the federal government, where the deposits are and everything else. But I would like to see the GEs and the Walmarts and the Googles and the Apples get into finance, because I think they would do a much better job. And you can regulate the functional entity that holds customer funds or does a brokerage business or whatever it is, right, much more effectively. And then you have a very large liquid parent behind it, and I think they would manage it much better, because today we have a ghetto of regulated entities, right? And even though their activities are constrained by regulation, they're also protected, because in order for you to own a bank, you have to go to the Fed and get permission, right? I think we should get rid of the last piece of Glass-Steagall, which is the Bank Holding Company Act. It was actually passed in '56, but that to me is the better route. You don't want to protect these institutions. You want to subject them to competition. And then, believe me, they would change. If you repealed that law, this whole industry would change.
That's an interesting point. And a lot of the liberals and progressives would argue, well, if you deregulate the financial industry, then they'll start speculating again, and then they'll start stealing the money in our deposit, and then we have another 2008 crisis all over again.
Oh, no. You would have tough regulation, but you see, it's very hard to take criminal prosecution against people today. It's hard to prove these cases. So most of the cases you see are civil actions brought by the SEC. But if you look at something like MF Global and John Corzine, who I believe deliberately stole customer funds, then, I think it takes on a different coloration, and we need to have receivers appointed and go after it the way we did with Alan Stanford down in Texas, who had the offshore scheme. He got prosecuted very quickly because the first thing people understood about it was fraud. But back in the 20s, it took us years and years to figure out that fraud was the issue on Wall Street. And we're going through the same process today, and it's unfortunate because the longer we avoid confronting this and realizing that that was the problem, not a lack of capital or some of these other issues you see when they talk about banks, it was really that people were making bad securities and selling them to investors, and people one day woke up and realized what they owned. And then they ran away, and that's why you had this horrible liquidity crisis. I was emailing today with Chairman Bear, and she always asked me, don't really bugging me, saying, why are you writing about this? Why do you say banks don't need more capital? And my answer is very simple, because the problem was fraud. It wasn't that, necessarily we were doing more or less stupid things than in the past. It's just that the fraud was so huge, and that made the number bigger. You know, a lot of subprime debt, they pretended it was backed by mortgages that don't exist. So, you know, that's a basic problem.
And that's a great point. And you know, one of the sad things that came out of the 2008 financial crisis is that nobody really went to jail for the fraud that they did during the mortgage crisis, the housing bubble, or even with the MS Global scandal. John Cordine's still out free, and I hear he's trying to start a hedge fund, which scared me a little bit. But anyway, I do believe free market and capitalism will be better served for the financial industry rather than having 100% regulation and total restriction, which is not very good for customers like us looking for lower costs and good service.
Hmm.
And so I want to shift gear here and talk about the Basel Level 3, which is expected to roll out pretty soon.
Hmm.
Now, I looked into this, and I had a hard time comprehending what it is and how it's going to affect the banking industry. Can you explain in layman terms what this is and how it will affect the banking industry as a whole?
Well, I think the good part of Basel III is that it will simplify and tighten up some of the capital rules. The bad part about it is it's very complex, and it's so complex that the regulators got buried with public comments, and they actually had to delay the implementation process while they go off and read these comments and figure out what they're going to do. I think it's going to result in less leverage in the economy. In other words, you're going to have less credit available for a number of reasons. And so what I think it will do is reduce returns at banks. You know, banks are going to be doing single, maybe low double-digit return on equity instead of twice that, which was very common during the boom. And so, you know, for consumers, for business, it means less credit available. That's really the bottom line of Basel III. It's an attempt by regulators to respond to the crisis. But I don't think they're fighting the right war. I think the crisis was about investor confidence. And no amount of capital is going to save you when people decide they don't want to trade with you anymore. You know what I mean? We're talking about the difference between 3 and 6 or 7% capital assets for the big banks. But would that have helped them in 2007? I don't think so. You know, that was about funding. So, you know, I think, like, as usual, the political class doesn't want to really squarely engage on what the actual issues were in the crisis, which was bad housing policy and a refusal to enforce the law when it comes to securities fraud. So, you know, those are two problems that are, I think, in our face. But, you know, the elected officials just do not want to deal with it. Because I'll give you an example. Andrew Cuomo and Eric Schneiderman here in New York, the Attorney General, know about the big banks, and they know about things that the big banks have done with respect to taxes and other issues that could get them all barbecued. Under New York law, the Attorney General here can pretty much have his way with big banks when it comes to fraudulent securities, because every trust that issued those bonds is under New York law. So Eric Schneiderman has a direct interest in each one of them. It's like he's an officer of the trust. And they could easily pursue this, but they don't want to, because they don't want to mess with the big banks for political reasons and other reasons. So there's a lot of stuff that's fallen through the cracks deliberately. And this goes right up to Barack Obama. You know, the thing that was most striking about his first 4 years was the total refusal to go after any of the big banks with the U.S. attorneys and the Department of Justice. They just kind of gave the whole thing a pass, which I think is unfortunate. Because even if you think you have a marginal chance of winning in court, I think in a political sense you have a duty to take them to court and just make a point about their activity. In the old days, we had no such problems. You know, Morgenthau and Roosevelt in the 30s had no problems putting people in jail. Jesse Jones, too.
And that's a great point. And you touched a little bit on leverage. And one of the things the bank really loved to do is take leverage during the past couple of years. And there's many reports out there that there's over $800 trillion worth of derivatives out there. Do you believe that market will collapse down the road?
Well, derivatives are gaming instruments. They are by their nature unstable, because over-the-counter derivatives, unlike a futures and options exchange, allow concentrations of risk on one side or the other of a trade. So long or short, a corporate name, for example, in terms of risk. And because they're bilateral contracts and because the customer deals directly with one bank, you don't have the disclosure you have in an exchange where all the banks are joint and severally members and owners, and they all watch one another because they have an exposure committee and everything else, and they try and manage the risk so that the dumbest guy in the room doesn't destroy everybody else, right? So the over-the-counter volumes are problematic in that sense. I was talking to another regulator last week about this, and no amount of capital is going to protect you if you can't risk manage the open interest and really understand who holds the exposure, right? So I think that, you have a problem in a sense that you let these instruments exist in the first place, especially if you have a derivative that doesn't have a real basis. In other words, they synthetically create something, and they say, well, it has these characteristics, but it doesn't have a visible cash market the way gold or silver or oil does. Because when you have a visible basis market, as they call it, you know what the derivative's worth. You can figure it out very easily. But when you have these synthetic markets where there is no basis for the derivative, supposedly, right, you're creating risk that nobody understands, and which can vary quite a lot. So, when you have the lack of public disclosure, the lack of risk management, and then the nature of some of these things where they have no visible basis in the cash market, I think those are all big problems. And, no amount of capital is going to protect a bank in a market like that, because at some point someone will screw up. Look at the example last week where you had a trader at Rochdale Securities buy too much Apple, just a long position in equities that was way too big, and he cratered the whole firm. Literally destroyed the firm. So, even with cash instruments, you can do stupid things and cause big problems. Derivatives give you a lot more leverage per dollar of capital. And so they're much more dangerous as a result.
And that's a great point. And Warren Buffett put it in a good way that derivative is a financial weapon of mass destruction.
Yeah, but he uses them all the time. He's benefited from derivatives enormously.
Yes, he does, and he talks out of both sides of his mouth.
Yes, he does.
When it comes to the economy and investing, and he's also one of the big advisors when they're doing the bailout back in 2008, because he had a big exposure to Wells Fargo and the other banking industry, and it's kind of disappointing when I heard about it, because Warren Buffett is a great investor, and it's unfortunate that he was involved in that type of affair and incident. Now, I want to switch gear here and talk about a little bit more about the bailout that occurred in 2008. A lot of people say that if that bailout did not occur in 2008, we would have been in a Great Depression like back in the 1930s, which might have been true in the short term, but in the longer term, I believe the financial sector would have been in better shape longer term if they didn't have the bailout and they failed and we started over. Do you agree with that?
Well, I think because of the magnitude of the problem, in a practical sense, you probably had to have some role for government in terms of buying assets. So AIG comes to mind, General Motors, Ally Financial. There's a couple other situations where the government put money on the line. And that, is right or wrong depending on how you see free markets. I think the point I would always make is that we have avoided restructuring. Now, AIG's been restructured, interestingly enough, and they're pretty much cleaned up. The firm is in very good shape compared to where it was. But if you look at Bank of America, if you look at some of the other banks, they still have profound problems going back to the securities that they sold to investors. And those problems are going to take time to work out. I still think Bank of America needs to be fixed in bankruptcy. So, it really comes down to, if you want to get the economy moving again, and if you want to make these assets useful so that they can support leverage and you can get job growth and everything else, then I think we have only kind of gone halfway. The Fed has bought a lot of time with low rates, and they're punishing investors and savers particularly through financial repression with low rates, and they're going to continue to do that for years. But we haven't really attacked the structural issues in the banking system because nobody wants to do it, particularly Bank of America, which is effectively crippled by the legal claims that they're facing. But we pretend that they're okay, or we try to. So I think that in terms of the bailout, we forgot the lessons of the 30s, which is you use government money to buy time and credit, and you try and put the assets in private hands as quickly as you can, which FDIC certainly has done. But the magnitude of the problem here was huge. It still is. The amount of real estate that's still out there that we're renting and doing other things with because it can't be sold is quite daunting. So as I've kind of watched this process, I'm most critical of the lack of restructuring. I'm less critical, I think, than I have been in the past in terms of the role of government, simply because there was nobody else there to buy it. And in that sense, yeah, you needed to deploy capital to make sure that the world didn't just melt down. And to some degree, they've been successful with this, right? But when you see the Treasury crowing about the money that they've made selling stock in AIG or whatever they've sold, right, they're not really making a profit. They're just getting their money back in small part, too. And there have been big losses to the government as well. That's kind of normal. But you got to remember, public policy made this all happen. Housing policy created these assets that caused these losses, both to investors and to the public. And I think if we step back and just say, okay, if we don't want to do this in the future, back to your point about Glass-Steagall, maybe we break the banks up and we don't have them concentrated the way they are now. But there are many other aspects to this to try and get an economy so that you don't have to have bailouts. That's really kind of the way I look at it.
And that's interesting. Now, my final question goes back to the customers that have their bank parked with all the big banks. And a lot of people there are afraid that they might lose their deposit down the future, like that happened in the Great Depression. If you would recommend people where to park their money, would they be better off in a smaller bank or credit union, or do you recommend that they stay with the big bank?
No, I think it's it's a mistake not to look at the smaller institutions. My company out in California, Institutional Risk Analytics, rates every bank in the U.S. So if you're a business person or an investor and you want to stay above the insured limit in a given bank, go buy the ratings for $50 a year. And, that's how I would manage it. As long as the bank is stable and they've got a rating above a B from us or from any of the other decent agencies out there that follow banks, you can be above the insured limit. I think what you have to be careful of is that you don't want to not have a relationship with a small bank, because if you're in a town, let's say you have a business and you have an account at one of the big guys, you should still do business with the other banks, just in case you need the credit, you need some other services. They're going to give you better service. Credit unions, same way. I'm a little concerned about the way they've been letting them get into business lending, because they really don't have the expertise or the systems to handle that. But they're also very useful. They support the mortgage industry very much, and that's the traditional role for the credit unions. They've been very good at it. So I think it's always important, if you're a business person or you're just a consumer, you want to have diversity in your relationships, not so much because you're going to lose money in a bank failure. That's very unlikely. But you want to, just in case you need a mortgage, you want to grow your business, whatever it is, you should always go talk to that small banker in your town, because that banker wants your business. And they may give you much better service and a much better rate, because a lot of these little banks are core funded. In other words, they have deposits as their funding, relatively cheap for the bank, and they're looking for quality assets. So it's, I always encourage people, go talk to the banker you've never talked to, open a checking account there, keep a little bit of money in it, simply in case you need to go talk to somebody. Because like you were saying before, the big banks have a monopoly in a certain respect, but the little guys are looking to lend. They really are.
And people can find ratings for all the banks on Institutional Risk Analytics. That's correct?
Right. And the shopping cart's actually IRABankratings.com. We came up with a consumer product because, most of our customers are institutional, and we have a very big model for each one of the banks. But we kept having people call us. And my partner, Dennis, very astutely put up a little shopping cart. And it's popular. We have a lot of corporates who use our retail product. For example, Walmart. They have hundreds and hundreds of bank relationships all over the country, because each one of their stores clears their point-of-sale transactions through the local banks. It's part of their community relations efforts. So they have to manage that risk. There's many other corporates that use the product, and they seem very happy with it. It's essentially a census of the industry. So it gives you kind of a historical sense of where the whole industry is every quarter as well. And as I said before, they are improving.
Great, and I recommend everybody to